So today we're going to go through the multifamily terms and definitions. What do I mean by multifamily terms and definitions? Like property types and aspects. We have property location and market and deal searching, right? We have a property financial analysis. Like each one of these segments has different terms. And if you don't know what the terms mean, you can't talk to another multifamily investor and be on the same page. So we're going to start here with property types and aspects. So term number one that we're going to go through is cash flowing property. This is an investment that generates money each month after all expenses are paid. So let's look at an example. Say you have a 100-unit property and you're charging $1,000 a month in rent. You're getting $1,000 a month from each one of those tenants. And then for each one of those, for that property, you have $500 a month in expenses for each unit. So that means you have $1,000 in rent, $500 a month in expenses. That means you have cash flow of $500, right? And that's for each unit. So then you'd multiply that by 100. But that means there's this cash flow over and above your expenses that are being paid. So that's what a cash flowing property is. Then we have down here in under the property location, right, and market and deal searching, right? You're going to have an offering memorandum. Like this is what brokers will use to market a property. It's basically a sales message. It's going to be all the pretty pictures and all of the demographics of the area, all of the information about the property, how many units, how many are renovated, how many are not, what's the rents for the units. Then you're also going to get the rent roll. Now this is going to be more detailed information. The rent roll is going to have all of the rents for the property. It's going to have all of the tenant names at the property. Then it's going to have all of like if you're charging for parking, if you're charging for a pet, it's going to have this all in a spreadsheet. Now the rent roll is really important because on the rent roll it has the rent that the person's actually paying, and then it has the market rent. So the market rent is what you're actually advertising the property for. So when the market rent and the rent that the person's actually paying, when that's closer to each other, then you know that there's potential for you to increase rents at the property. Now, if there's a big spread between the market rent and what you're actually getting in the property, so like for example, if you're getting $1,000 a month at the if you're marketing the property for rent at $1,000 a month, and you're only getting $800, that means that that's a pretty big difference between what you're marketing at and what you're actually someone's willing to pay. So that would let me know that like maybe this deal doesn't have as much opportunity as I initially had thought it did, right? But if I'm buying a property that has rent at $1,000 and then I'm getting $1,000 a month in rent, then that lets me know like, hey, I need to dig into this. I might be able to increase rents to $1,100 because people are already paying the market rent. There's opportunity there. Then you have your T12. That's your trailing 12. This is a profit and loss statement showing the actual reported numbers for the last 12 months. So it's basically a financial statement. It's going to be your income up top, which is going to be your rents that you charge for the property. There's going to be your parking, parking and any other income expenses you may have at the property. Then you're going to subtract out your expenses, and that's going to be it could be trash, it could be sewer, it could be repairs and maintenance. So you have your income up top, and then you'd have your expenses at the bottom, and then the T12 would subtract your expenses from your income to give you a net operating income at the bottom of the T12.
Those are some of the three most important things you guys look at when you're first starting to evaluate a deal. If you're looking at a deal, you don't have those three documents, you got to get with someone and ask them, and you got to get those documents because those are going to tell the story right off the bat for your deal.
Yeah. Well, that's whether you're talking to a broker or you're talking to the owner directly. These are the three most important documents that you're going to need when analyzing a deal. Right. So then we have under property financial analysis, right? We have member and manager equity. So this is what the operators of the deal, this is the equity that they would have. So like, typically what I see for multifamily deals is you're going to have owner member equity and passive investors equity split at like a 70-30 or 25-75, right? So that means the members would get 25% of the deal, and then the passive investors would get 75% of the deal. Or that would mean that the members would get 30% of the deal, and the passive investors would get 70% of the deal. So it basically splits the ownership from the members' equity to the passive investor equity. Brian, is there anything you want to add on that?
Well, yeah, that's a number that it can change from deal to deal too. You know, every deal you look at is not going to have the same split. It's going to be based on whatever the management team is that's putting the deal together, how good their track record is, what kind of equity split they can command. So it's definitely an important number to keep an eye on, just so you know exactly what your share of a deal is going to be as an investor, or if you're putting the deal together, what that split for the manager team is going to be.
Yes, totally agree. Yeah, I've seen things 50-50 splits, 60-40 splits, 70-30, 75-25. Yeah, it ranges, but you know, it's good to know the difference between the member equity and then your manager equity, right? So then we have down here, we have banking and loans, right? So then we have the fixed rate mortgage, right? So what's a fixed rate mortgage? It's similar to if you were to buy a single family home, you lock in on a mortgage, whether it's 6%, 5%, or 4%. You pay that 4%, that 5%, or that 6% through the life of the loan, right? The interest rate doesn't change. For a floating rate interest rate, that's going to go, the interest rate is going to go up and down, and it's going to float, and it's going to change with the market. So right now we're in a time, this is August 2020. So right now we're at a time of low interest rates. So the floating interest rate is going to be low. But if we move to a time of high interest rates, then the floating interest rate is going to be high, right? So it's going to so you're gonna have some change, right? You're gonna have some ups and you're gonna have some downs. Whereas the fixed rate mortgage, it's gonna be flat the entire time. You know what you're gonna be paying, whether in high interest rate times and then low interest rate times.
What do you think, Oliver? You'd prefer to lock in with a fixed, or are you going for floating?
So it's really just property specific. Like if you're gonna be in a property, right, that's short term, for a floating interest rate, you typically would even be able to get a lower interest rate than if it was a fixed interest rate. So if you're going to be in a property for a short period of time, it makes sense to do a floating interest rate because you're paying less interest up front. But if you're going to be locked in, if you're going to be in a property for 10, 15, 20 years, you probably want to go with a fixed interest rate because now you know whether in good times or bad times what your interest rate's going to be, right?
Yeah, I totally agree. Yeah, if you're going to be in it for a while, I don't like surprises coming up later on. I'd rather stick with the fixed for a longer time frame investment.
Yes, exactly. So then we have a limited partnership. A limited partnership business is an entity set up for 2+ members, right? So so a lot of real estate is bought with multiple people, especially the big deals. The big deals are always bought with typically a group of people. And that's when you would want a limited partnership. It would provide you protection. So like you go into this partnership, it's its own entity. So like if something were to happen at that partnership, they can't come after your home. They can't come after your personal bank account. They can't come after your other investments. They can only come after that one entity. Is there anything you want to add to that, Brian?
This is an awesome protection that we can use. It's definitely, whenever you buy anything property related, it's really good to do it in a partnership or an LLC or some kind of separate entity that affords you this kind of protection. This is huge right here.
Yes, totally agree. Yeah, I buy all my real estate in an LLC. I don't buy it in my personal name. It's just too much liability if something were to go wrong or something were to happen, right? So totally agree with that. Then under the key players in the property transaction, this is the deal analyzer. This is the guy that loves the financials. He's a specialist. He's an analyst, right? He reviews the deal from a financial and investment standpoint. Now this is definitely Brian Kinney, so I'm going to hand this on off to him.
Yeah, this is my specialty, but as you can see here, there's specialties for everybody, right? So, just because you're not analytical doesn't mean you're not going to have a job, right? Just because you're not a rehabber doesn't mean you can't do something for the property team. So yeah, definitely a good section here for you to kind of take a look at and kind of see where you might fit in.
Yeah, love that. Love that. Yeah, Brian, I'm a rehabber. Brian's a deal analyzer. Brian adds a tremendous amount of value to me. He loves the numbers. Great, Brian, go dig into some numbers. I'll focus on the construction and rehabbing the property. So it's a great thing. You want to definitely be around people who have strengths where you have weaknesses, right? So it's about building a team. You can't do everything on your own. So put good, strong people around you. So under making offers and closing deals, we have the letter of intent. Now the letter of intent is a non-binding agreement drafted by the buyer proposing their purchase terms to the seller. The seller would then get the letter of intent and then be able to review the offer, right? And if they agree with your terms on the letter of intent, they'll sign the letter of intent, and then that will give authorization basically to move to a purchase and sale agreement. And then that's the main contract that would drive the purchase of the property, right? But the letter of intent is just basically you telling the seller how you're looking to purchase this piece of real estate or this transaction. You're going to lay it all out, right? It's going to have the purchase price. It's going to have how long it's going to take you to close. It's going to have how much money you're going to put down as an EMD and whether or not that money goes hard. What does that mean by money going hard? Well, that means that like after 10 days or after 15 days, your EMD or your deposit is non-refundable. Like you lose it if you back out on this deal. You lose it if you decide not to move forward, right? So, Brian, is there anything you want to add on that?
Well, a key piece of this to me is the non-binding aspect, right? Just because you send an LOI out, right, doesn't mean that this is your final price for the property, right? This kind of begins the negotiations more than anything else, right? So it doesn't have to be the end all be all number of the deal.
Yeah, love that. Yeah, totally agree. So that's what we have for the terms and definitions, multifamily terms and definitions. And there's multiple sections. There's making offers. And you can see here, there's 1031s, due diligence, exit strategy, holding period. It goes through all of this stuff, right? It gives you exactly what that term means. So when you're talking with someone and you're communicating with someone, and they use these terms, you can actually understand what they're talking about, right? And when you understand what they're talking about, then you can actually make a decision whether it's good or bad. You can make a decision. You know what you're making a decision on. There's key players. We went through that. We went through the deal structure, right? The K1's partnership offer using OPM, other people's money. I love that, right? I know you're gonna love that too. We have banking and loans. It goes through everything: escrow, pro forma, appraisals. Gives you exact definitions for what all this stuff means, right? This is going to give you the ability to communicate, right? Communicate with other multifamily investors, talk on the same language with them, right? You got property financial analysis, property location and market deal search, right? Then all the way up top, we have property types and aspects.
Yeah, so it's a good cheat sheet, guys. It's kind of organized into the relevant categories. So, if you're, just getting into the deal search and you're getting curious on some of the terms, right, you can flip right to that page and we try to organize it like that for you.